China is going through a 2008 style property market crash. Here's how it happened, how it's impacting the rest of the Chinese economy, and what scenarios I'm watching to see how it could affect the Chinese market and the broader global stock market.
China's leading property developer, Evergrande, files for bankruptcy protection in a US court.
Across China, developers have come close to collapse.
I bet you didn't know this. The Chinese property market is the largest asset class in the world, worth an estimated $62 trillion. That's about 4 years worth of China's GDP. And in this story or movie, there are elements of 2008, elements of a Bernie Madoff-style Ponzi scheme, elements of the Enron scandal, and global effects that could extend well beyond what any of us could have imagined. So buckle up, Buttercup, and get ready for a wild ride. The easiest way to understand how the property crisis unfolded is to split it into two elements: why the system was bound to fail, and what changed to finally bring it crashing down. At the crux of the problem is a broken business model and potential fraud across the Chinese property sector, which was basically a Ponzi scheme. It only worked as long as prices kept rising. But now, the party has come to an end. Think about it like this. A property developer always has to buy new land to replace the land that they've developed, right? And in China, there was usually at least a few years between when they bought the land and when they sold the apartment building or office complex or whatever they built on it. So pay close attention here. On a cash basis, they were selling properties at today's prices and buying new land at today's prices. But on an accounting basis, they were selling property at today's prices and booking the cost of that land at the prices from 5 years ago or whenever they bought it. And land prices were always going up. So the prices from 5 years ago that they used for the cost were always lower. That made it look like they were making a profit, but they were actually losing money. They would also sell projects when they were only partially complete. And since they were actually losing money on most of the projects, they needed the cash from pre-sale of new properties to finish the construction on the old properties. As long as they kept selling more and more new properties and land prices kept going up, the Ponzi scheme could keep going. Unfortunately, no Ponzi scheme can last forever. You see, high property prices were creating two key problems that the government saw as significant long-term threats to China's future. The first is a shrinking and aging population. I've talked about this in a lot of my other videos, but China's working age population peaked in 2015 and is projected to decline significantly over the next 30 years. That means fewer people producing things and more people to take care of. Not a good recipe for growth. The main culprit for that is China's declining birth rate. And a key reason for the declining birth rate is that people in China usually don't want to have kids until they get married and buy a house. But housing has gotten so expensive that it takes them a long time before they can afford one. So because of high house prices, people wait longer to start having kids and they don't have as many. The second long-term threat to China's future that they're trying to solve comes from the massive debt within the property sector and local governments. It was policy changes designed to tackle these long-term issues of housing affordability and excessive debt that exposed the flaws in the system and led to the current crisis. For many years, housing has been by far the most common way for people to grow their wealth in China. The stock market historically hasn't been very reliable. The bond market has been underdeveloped and bank deposit rates have been lower than inflation. So people bought property. That led to President Xi's policy that housing is for living in, not speculation. The thinking went, if we stop rich people from buying up their fourth, fifth, or sixth houses for investment purposes and driving the prices up, maybe some more young couples will be able to afford one. Makes sense, right? Yes. Except it wasn't well understood at the time that property developers and local governments needed prices to keep going up, or the whole system would come crashing down. The other big regulatory change was the 3 red lines policy in 2020, which was designed to reduce debt in the real estate industry. The restrictions got even tighter in 2022, cutting off a lot of property developers from the financing they needed to keep going. Remember, they needed money from new purchases to complete the construction of old purchases. So it went a bit like this. New policies blocked some people from buying homes and convinced everyone that prices weren't going to go up as much anymore. Naturally, buying activity plummeted. Revenue from new home sales declined significantly. And since property developers also weren't allowed to borrow as much anymore because they already had too much debt, they had no way to finish building people's homes that had already been paid for. That led to an even bigger decline in buying activity because who wants to buy a house if they don't even think it will be completed? As I'm filming this, over 50 Chinese property developers have either defaulted on their debt or missed interest payments in the past 3 years. Evergrande, which used to be the biggest one, just filed for bankruptcy.
Shares of Country Garden plummeted to the equivalent of 12 U.S. cents in Hong Kong.
It is highly likely that it will get worse before it gets better. It also looks like there might have been widespread fraud at Evergrande. Their auditor, PwC, just resigned in June, and the company went back in time and significantly reduce their revenue from prior years. So what that means is that it's likely that they were overstating their revenue or recognizing it early to inflate their numbers and make their finances look better than they really were. Huge red flag. In order to understand how the property crisis is feeding through to the rest of the economy, there are two things you need to know. First, how the local governments were involved, and second, the integral role the property market has played in China over the past few decades. Let's start with the local governments, which also had some Ponzi scheme elements in their role in all of this. In China, local governments are responsible for almost all the spending on infrastructure and public services, but collect only about half of the tax revenue. One of the main ways they fill that gap is by selling land to property developers. For years, the incentive from the central government was growth, growth, growth. Local government officials enticed businesses to come invest in their city by giving them incentives, like cheap land. That was the main formula for growth. Not only did these companies produce things, but they also brought in more people, more demand for things like haircuts and restaurants, and all of that helped local government officials meet their growth targets. But in the long run, that created two problems. It led to a bunch of zombie cities. It's estimated that there are 60 to 80 million empty apartments in China due to overbuilding. It jacked up the prices of residential land because there was less of it available and more people in need of housing. In China, because of all these incentives to bring in new businesses, land for industrial use only cost about 5% as much as land for residential use. In other words, it's a 95% discount. On sale, 95%. The girls will get that one. Okay, so local governments rely on ever more property sales at ever higher prices to pay their bills. About 40% of their revenues are property related. So what happens when President Xi says it's not about growth anymore? Now it's about reducing debts? Well, property developers can't afford to build. And if property developers aren't building, local governments aren't selling land. And remember, they were responsible for the infrastructure boom that fueled China's growth for the last 20 years. This is a huge blow to China's growth model. To make matters worse, China's National Audit Office found that around 70 different local governments inflated their revenues by selling state-owned assets and land to themselves. The government was selling land that the government owned to make it look like they were generating revenue, but it was totally fake. That's pretty much exactly what Enron got caught doing in 2001. As if China's broken growth model and local government's inability to provide basic services weren't enough, the links to the rest of the economy go way deeper than you might think. First, jobs related to the property market, from construction to painting to furniture to landscaping, are evaporating. Second, and much more importantly, it's leading to a confidence crisis in China. Estimates range from about 60 to 70% of people's wealth in China is tied up in property. There's a psychological phenomenon called the wealth effect that basically says that when people feel wealthier, they're more likely to go out and spend money. Well, people are really worried about the outlook for the economy right now, so they're saving more and pulling back on spending. When they pull back on spending, that weakens the economy even further and starts to impact restaurants, movie theaters, airlines, and all kinds of industries that have nothing to do with real estate. Oh, and by the way, if you think that things are actually great over there in China and it's just my closed-minded American point of view, get this. China's consumer confidence is so bad that they actually stopped publishing the figures in April. Historically, property stimulus was the main way the government boosted the economy when times were tough. But if they don't want to take on more debt in the property sector, the way out is going to be a lot harder this time. So what's next for the Chinese stock market, and how could this crisis impact the rest of the global economy? That's me and you, Americans. Well, there are a lot of moving parts, and it's never easy to predict the actions of an authoritarian government, but here are some of the things I'm watching for. Anecdotally, when things seem the worst, it's often a good time to invest. I personally think this will get worse before it gets better. So I'm holding my very small investment in China, but not adding to it yet. Odds are there will be some major rallies over the next few years, but predicting the timing or magnitude is essentially impossible right now. Here are some of the things I'm watching out for. The number one most important thing is, do they stimulate the economy enough to make a difference? If they do that, that's how things get better. I don't mean a 0.1% rate cut like they did a few weeks ago. I mean something to really move the needle. And if so, what does that really look like? Do they take on more debt with the property sector? I doubt it, but that was the old formula, so you can't totally count it out. Do they quietly abandon or downplay the housing is for living, not for speculating policy? I could see that happening, and that would likely lead to a big recovery. Do they remove the price cap on new houses? They're about 30% cheaper than secondary houses. If they did, that would boost sentiment. Do they do more traditional fiscal spending to help people in ways that are unrelated to the property market? Something along the lines of stimulus checks? Okay, so I think that would be effective, but I don't think they do it because historically they've shunned that kind of thing. So what about if they don't stimulate? Could things get worse? Yes. in a few ways. There are lots of linkages to the financial markets. Not so much to where they'd bring down a major bank like in 2008, but investment companies like the trust companies and investment products like wealth management products have a lot of exposure to real estate. 37 of China's 68 trust companies either saw a profit decline of more than 20% in 2022 or didn't report any data at all. And if you don't even report your data, that's how you know things are really bad. More than 10% of China's trust companies have already defaulted on their debt, including one in August. If trust companies and WMPs start going down, or property developers start defaulting on domestic debt instead of foreign debt, things could get a lot uglier. The linkages to non-Chinese investments go pretty deep too. Chinese consumers are really important to the luxury goods companies in Europe and the US. Chinese housing production is really important for iron ore demand and has a noticeable impact on the Brazilian economy. And newsflash, when you're the second largest economy in the world, major economic strength or weakness is typically felt well beyond your borders in places that you have close ties to. That means the US, Europe, Australia, other Asian countries, other BRICS countries that all sell a lot of their products into China. So basically the whole world. Those areas will be negatively impacted if this crisis lingers on, and positively impacted if and when it recovers. This is definitely a difficult situation to predict, but my most likely scenario is somewhere between the big stimulus / rapid recovery and the widespread defaults disaster. I do think we'll get more stimulus in the next couple months, but I fear it'll fall short of the market's expectations. I don't think the government will allow widespread defaults on domestic debt, local government financing vehicles, wealth management products, or anything else either though. Now, I hope I'm wrong about that because the short-term economic pain will be somewhat of a reset that will be good for the economy in the long run. But my expectation is that they'll play the extend and pretend game. What I mean by that is that since they control the banks that provide 90% of the funding to the property market, they can basically tell the banks to just let indebted local governments or property developers pay back their debt later. Actually, there's a lot of this going on already, so it's not really a bold prediction. The default issues would be a lot worse if they were actually reported. In this scenario, there's never a big blow up, but these issues linger and weigh down the economy for years. Confidence remains challenged, they keep battling deflation periodically, and by 2030, few people will still be predicting that China's GDP will ever catch up to the US. I hope I'm wrong, and part of me goes back to the fact that in investing, it's always darkest before the dawn. But until I can see the light a little clearer, I probably won't be adding to my Chinese investments. Last thing, I made a currency pro course. It is 10 videos, all free. Check out the link below in the description and in the first comment. Thanks for watching.